The Federal Reserve just did something most people have not heard about. And when you understand what it actually is, you are going to realize it affects every single dollar sitting in your bank account right now. I am going to break this down in plain English. No economics degree required. And by the end of this video, you are going to know exactly what the Fed did, exactly why it quietly hurts your savings, and exactly what you should be doing with your money because of it. That is the deal I make with every video. Not just the news, what to actually do about it. So let me start here. Everyone talks about the Fed raising interest rates or cutting interest rates. That is the thing most people understand. Rates go up, borrowing gets more expensive. Rates go down, borrowing gets cheaper. That is the version of the Fed that shows up in headlines. But the Fed has a second tool that most Americans never hear about until it directly affects them. And right now, in 2026, the Fed is using that second tool aggressively. It is called the balance sheet. And what the Fed is doing with its balance sheet right now is quietly one of the most important things happening to your money. Here's what you need to understand. For years after the 2008 financial crisis, and again during COVID, the Fed bought massive amounts of government bonds and mortgage-backed securities. They essentially created money out of thin air and used it to purchase these assets. This is called quantitative easing, and it worked the way they intended it to. It pumped liquidity into the financial system, it kept interest rates lower than they would have been naturally, and it helped the economy keep moving. But here is the problem with creating trillions of dollars to buy assets. You end up with a balance sheet that at its peak sat at nearly $9 trillion. That is $9 trillion worth of assets that the Fed was holding. And a big chunk of that represented money that the Fed had essentially printed into existence. When inflation started screaming in 2022, the Fed had to deal with that problem. And they dealt with it in two ways simultaneously. They raised interest rates aggressively. That is the part everyone knows. What fewer people tracked was that at the same time, they started doing the opposite of what they had done before. Instead of buying bonds, they started letting them expire and not replacing them. They were slowly draining that massive balance sheet. This process is called quantitative tightening. And by late 2025, they had drained about $2.5 trillion out of the system through this process. Now here is where it gets important for your money. In December 2025, the Fed made a decision that almost nobody in mainstream media explained properly to regular Americans. They quietly announced they were starting to expand the balance sheet again. Not through the same aggressive bond buying as before, but through what they called reserve management purchases, up to $40 billion a month of new Treasury purchases. Restarting the expansion. They said this was not quantitative easing. They said it was just managing reserves. But here is the honest truth about that distinction. When the Fed buys bonds with money, it creates, whether they call it QE or reserve management, the economic effect on your savings, on inflation, and on the cost of everything you buy is the same. More money in the system means your dollars buy less. That is the mechanism. That is how this hurts you directly. Now here is the part that does not get explained in most coverage of this. The Fed is doing this while inflation is still running above their 2% target. Not dramatically above it, but above it. As of the latest data, inflation is sitting around 3 to 3.8%, depending on which measure you look at. The Fed's own target is 2%. And instead of completing their mission and getting inflation down, they have now started a new phase of balance sheet expansion that by its very nature is inflationary. Let me make this as concrete as possible. When the Fed expands its balance sheet, more money chases the same goods and services in the economy. More money chasing the same stuff means prices go up or stay elevated, which means every dollar you have saved is worth slightly less tomorrow than it was today. That is not a theory. That is just math. That is how inflation works. And that is what balance sheet expansion feeds. So why did the Fed do this? The honest answer is that they did not have a choice as clean as they wanted. By late 2025, their quantitative tightening had gone on long enough that bank reserves were getting thin. There were signs of stress in the overnight lending markets where banks borrow from each other. The Fed was worried they had drained too much too fast, and if they kept going, they might trigger instability in the financial system itself, so they stopped tightening and started expanding again. And that is the impossible situation they are in right now. If they keep tightening, they risk breaking something in the financial plumbing. If they expand, they feed inflation. There is no clean option, and you, sitting at home with your savings account, your mortgage, your retirement account, are living inside the consequences of that impossible choice. There is something else worth understanding here that most people do not connect. The Fed is also dealing with a new chair. Kevin Warsh took over as Federal Reserve Chairman in May 2026 after Jerome Powell's term ended. And Warsh is coming into this role at one of the most difficult moments in recent Fed history. He is inheriting a balance sheet that is still massive at roughly $6.5 trillion. He is inheriting inflation that is above target. He is inheriting a jobs market that is surprisingly strong. And he is inheriting the balance sheet expansion that his predecessors just restarted. What this means for you is that there is genuine uncertainty about what the Fed does next. Warsh has historically been known as more hawkish, meaning he tends to favor tighter monetary policy to fight inflation. But he is also arriving at a moment when tightening too aggressively could cause real damage. How he navigates this transition over the next 6 to 12 months is going to directly affect your mortgage rate, your savings account yield, your retirement account, and everything in between. The next scheduled Fed meeting is June 16 and 17. Based on everything happening right now, including the jobs report that came out today showing 172,000 jobs added in May, more than double expectations, the overwhelming expectation is that Warsh and his team hold rates exactly where they are. No cut. And based on some market signals, a conversation about whether a hike might be needed later this year is starting to get louder. That possibility has real and immediate consequences for anyone carrying variable rate debt. Now, let me talk about what this actually means for each area of your financial life. Because understanding the mechanism is one thing. Knowing what to do about it is what actually matters. First, your savings account. Here's the uncomfortable reality right now. The national average savings account rate at regular banks is around 0.39%. That is not a typo. 0.39%. Meanwhile, inflation is running near 4%, which means if you have money sitting in a standard bank savings account, you are losing purchasing power every single month. Not because the stock market crashed, not because you made a bad investment, just because you left your money in the most common place people leave money. The Fed's balance sheet expansion makes this worse over time because it keeps upward pressure on inflation. The Fed is essentially running a slow tax on your savings by keeping inflation elevated while your bank account earns almost nothing. The solution here is immediate, and it costs you nothing but 10 minutes. High-yield savings accounts right now are paying between 4 and 4.1% annually. That is more than 10 times what a standard savings account pays. The difference on $20,000 is roughly $700 a year. On $50,000, that is close to $1,800 a year. That money is yours. You just have to move it. And there is no catch. These are FDIC-insured accounts at legitimate institutions. The only reason most people have not done this yet is inertia. Today is the day you fix that. Second, your mortgage situation. Here's the chain of events you need to understand. When the Fed expands its balance sheet and keeps inflation elevated, the 10-year Treasury yield tends to stay elevated because bond investors demand higher returns to compensate for inflation risk. Mortgage rates in this country track very closely with the 10-year Treasury, which means as long as the Fed is quietly feeding inflation through its balance sheet, the dream of mortgage rates coming down significantly is just that. A dream. If you have been renting and waiting for rates to fall so you can afford to buy a home, I am not telling you your strategy is wrong. I am telling you the timeline just got longer. The Fed's actions in December 2025, restarting balance sheet expansion, removed one of the clearest paths to lower mortgage rates because lower rates require lower inflation. And lower inflation is harder to achieve when the Fed itself is pumping money into the system. If you already own a home with a high-rate mortgage and were waiting to refinance, same story. The window that seemed like it might open this year just got pushed out further. Third, your retirement accounts and investments. This part actually has a more nuanced answer than you might expect. Balance sheet expansion, despite being bad for your dollars, is often good for asset prices in the short term. When the Fed pumps money into the system, some of that money finds its way into stocks and real estate, which is part of why markets have stayed relatively elevated, even with inflation running above target. But here is the risk hiding underneath that surface. If inflation does not come down, and the Fed eventually has no choice but to raise rates again or get aggressive with tightening again, that is when asset prices can fall quickly. The current balance sheet expansion is borrowing from future stability to prop up present conditions. That is not a permanent free lunch. For your retirement accounts, this means a few things practically. If you have a long time horizon, the most important thing is to stay invested and stay diversified. Do not panic. Do not pull everything to cash because of this video. But do make sure you are not concentrated entirely in assets that are most vulnerable if the Fed eventually has to overcorrect again. The assets that historically do best when the Fed is inflating are things like real assets, energy, commodities, and dividend-paying stocks with pricing power. The assets that get hurt most are long-duration bonds and growth stocks with high valuations relative to current earnings. That does not mean you should blow up your portfolio today. It means it is worth reviewing your allocation with fresh eyes. Fourth, your credit card debt. I talk about this every time because it remains the most urgent and overlooked emergency in most American households. Credit card rates right now are running between 21 and 24% for most people. The Fed's balance sheet expansion actually has a somewhat indirect effect here. It does not immediately lower credit card rates, but here is the connection. If balance sheet expansion feeds inflation and inflation stays elevated, the Fed cannot cut rates. And until the Fed cuts rates, credit card companies have zero incentive to lower their rates. So every month you carry a credit card balance in this environment, you are paying the price of the Fed's impossible situation. The urgency to pay down high interest debt is as real as it has been in years. If you have $5,000 at 22% interest, you are paying over $1,000 a year to service that balance. That money is gone. It builds no equity. It earns you nothing. It is a pure loss. Any extra dollar you can direct toward high interest debt right now is getting you a guaranteed 22% return on that dollar. There is nothing in the market paying that reliably. Paying off your credit card is the single highest return investment available to you if you are carrying a balance. Now, I want to step back and give you the bigger picture of what is actually happening, because I think a lot of people feel like the financial system is working against them right now, and they are not sure exactly why. The answer is actually not that complicated once you see it clearly. The Federal Reserve spent years inflating its balance sheet to keep the economy going. That created the inflation problem we have now. Then they raised rates and tightened to fight the inflation. That worked somewhat, but it created new stress in the financial system. So now they have restarted expansion to prevent that stress from becoming a crisis. But that expansion itself keeps inflation alive longer than it would have been. And in the middle of all of this is the average American. Your savings account earns almost nothing while inflation eats at your purchasing power. Your mortgage rate stays elevated because markets know inflation is not going away. Your credit card rate stays near record highs because the Fed cannot cut rates while inflation persists. And your retirement account may look fine today, but is exposed to the risk of whatever comes next when the current balance runs out. This is not a conspiracy. It is not anyone being evil. It is a system that is genuinely caught in a difficult corner. But understanding it is the difference between being passive and being intentional about protecting what you have. So here is the specific action list. Right now, not someday. Move any cash sitting in a standard bank savings account to a high-yield savings account. Do it today. It takes 15 minutes. The rate difference is real money, over $700 a year on $20,000. Make a plan for your high-interest credit card debt. Even $50 extra a month toward principal is a guaranteed double-digit return on that money. Build that into your budget now. Review your investment allocation with an eye toward whether you are holding assets that benefit from or at least are not destroyed by persistent inflation. Energy, real assets, dividend-paying companies with strong cash flow tend to hold up better in this environment. If you have a mortgage or are planning to buy a home, adjust your timeline expectations. Rates are not falling on the schedule most people hoped for. Plan your finances based on current rates, not rates you are hoping for. And stay informed, not in a doom-scrolling, anxious way, but in the way that means you understand what is actually happening to your money so you can make rational decisions instead of reactive ones. One more thing I want to address because I know it is on a lot of people's minds. Should you be buying gold right now? Should you be moving money into commodities or alternative assets because of what the Fed is doing? Here is my honest take. Gold and commodities do tend to perform well in environments where inflation is persistent and the dollar is being diluted through balance sheet expansion. That is not a theory. That is what the historical data shows. If you already have some exposure to these assets as part of a diversified portfolio, the current environment supports keeping that exposure. But I would not make dramatic moves into gold based purely on fear from a single video. The reason is that timing alternative assets is notoriously difficult. Gold can stay flat for years while inflation runs hot and then spike suddenly. You never know exactly when. If you want to add some inflation protection to your portfolio, a small allocation, somewhere in the 5 to 10% range, to real assets or inflation protected securities like TIPS, Treasury Inflation Protected Securities, is a reasonable and measured approach, not panic, a thoughtful, measured one. The Fed is not going to announce that they are hurting your savings. They will call it reserve management. They will say it is temporary. They will say it is separate from their inflation goals, but the math does not care what they call it. More money in the system chasing the same goods keeps prices elevated, and elevated prices hurt every dollar you have. If this gave you something that most coverage of the Fed never does, which is the direct connection between what they are doing and what it means for your specific financial situation, subscribe right now, because this is exactly what I build every video around, not just the news, the mechanism behind it and what you actually do about it. I have a lot more coming this week. Next up, I am going to go deep on what the Fed's June meeting is likely to mean for interest rates and whether there is any chance we see a rate cut, or if what I covered today suggests something more alarming on the horizon. Make sure you are subscribed so you do not miss that one.